Now let's look at interest rate buydowns. This is the most powerful and the most misunderstood. First, we have temporary buydowns. A 2-1 interest rate is the most common buydown, and it is the temporary financing strategy where the buyer's mortgage rate is reduced for the first 2 years of the loan. This is critical to understand, and the way that I explain this to my clients, the lender calculation on payment difference, the reduced rate 4.5 to 5.5%, and the full note rate is 6.5%. That difference is prepaid upfront and held in an escrow account. Each month, that account subsidizes the buyer's payment. So the buyer is still qualified at the full note rate. The loan itself is still written at 6.5%, but the buy down is just a temporary payment subsidy. This is beneficial if you're in a position where you just got into your starter position for your future career. You know the likelihood of your pay structure going down is pretty low. So if you're going to get a predictable, realistic, substantial raise in the semi-immediate future, this is a great option to explore. Good example for this is Houston law enforcement officers just got a nice pay raise. They knew about 10 months in advance that this was going to be approved and it was going to happen. So we got flooded with law enforcement officers buying houses that they were nervous that was going to be above their budget, but they were using this method because they knew more money was on the horizon. So they were able to get the house sooner, which means on paper, they got a better deal because the appreciation wasn't a factor here.